Ladies and gentlemen, imagine waking up tomorrow to discover that one of the largest financial institutions in the world believes an asset trading at $4,000 today could be worth $6,000 in the years ahead. Not because of hype, not because of a viral headline, but because the foundations of the global financial system may be shifting beneath our feet. Now ask yourself a simple question. If analysts at one of the world's biggest banks believe gold has that much potential, why isn't everyone talking about it? Why are the evening headlines focused on daily price swings while some of the biggest investors continue watching gold with extraordinary attention? Tonight, we're going beyond the headlines. We're going to examine what could be driving these long-term forecasts, why government debt, central bank buying, interest rate policy, and global uncertainty continue to put gold at the center of financial conversations, and why respected analysts don't all agree on what comes next. We'll also look at the risks, because every investment has them. By the end of this video, you'll understand the economic forces behind these projections, what could support them, what could prevent them from happening, and why millions of investors continue treating gold as more than just another commodity. Let's begin where every major financial story starts, not with today's price, but with the forces quietly shaping tomorrow. The debt question. Nobody can ignore one of the biggest reasons gold remains part of today's financial conversation is government debt. Around the world, many governments have borrowed enormous sums over many years. Debt itself isn't unusual. Governments have always borrowed money. The question is how that debt is managed. As debt grows, interest costs also increase. When interest rates are high, servicing that debt becomes more expensive. Higher borrowing costs affect government budgets, businesses, homeowners, and consumers alike. This creates difficult choices for policymakers. Should rates remain high to control inflation? Or should rates eventually fall to reduce financial pressure on the broader economy? No one knows exactly how this balance will develop. But markets watch these decisions carefully because interest rate expectations influence nearly every major asset, including gold. Historically, gold has often attracted greater attention during periods when investors expect easier monetary conditions or worry about the long-term purchasing power of paper currencies. That doesn't guarantee higher prices, but it helps explain why gold frequently becomes part of the conversation whenever economic uncertainty grows, why central banks matter. Perhaps the most interesting development isn't what individual investors are doing. It's what central banks are doing. Over recent years, many central banks have steadily increased their gold reserves. Each country has its own reasons. Some seek greater diversification. Some want additional financial resilience. Others simply prefer holding a broader mix of reserve assets. Regardless of motivation, these purchases have become one of the most closely watched trends in the precious metals market. Institutional buying doesn't automatically push prices higher overnight. Markets are influenced by countless factors. But sustained demand from official institutions often attracts the attention of professional investors. It raises an important question. If organizations responsible for managing national reserves continue increasing their exposure to gold, what risks are they preparing for? No single answer exists. Some analysts point to geopolitical uncertainty. Others emphasize inflation. Others focus on diversification. Whatever the explanation, central bank activity has become one of the most important long-term variables in today's gold market. And that's exactly why investors continue watching it so closely. The US dollar versus gold. To understand why so many institutions continue watching gold, you first have to understand its long-standing relationship with the US dollar. Think of them as two sides of a financial balance. When confidence in the dollar strengthens, investors often feel comfortable holding cash and government bonds because those assets offer both stability and income. But when confidence begins to weaken, whether because of persistent inflation, rising debt, geopolitical uncertainty, or expectations of easier monetary policy, many investors start looking for assets that exist outside the traditional financial system. That is where gold often enters the conversation. Unlike a currency, gold cannot be printed. Unlike government debt, it carries no promise that depends on future tax revenues. Its value is determined by what buyers and sellers around the world believe it is worth. That is why many investors view gold less as a way to become rich and more as a form of financial insurance. Today, the relationship between gold and the dollar is being watched more closely than it has been in years. The United States continues to finance enormous levels of government spending while global investors closely monitor every statement from the Federal Reserve. If inflation proves stubborn, interest rates may stay elevated longer than markets expect. If economic growth slows sharply, policymakers could eventually choose a different path. Either outcome has important implications for the dollar, and by extension, for gold. This is why professional investors rarely ask only one question: where is gold today? Instead, they ask something much more important. What is happening to confidence in the world's reserve currency? Because history has shown that confidence can influence financial markets just as powerfully as economics itself. Why some analysts disagree at this point, it might sound as though a higher gold price is inevitable. But that would not be an honest conclusion. Markets are never one-sided. There are experienced economists and investment firms that remain far more cautious. Their argument is straightforward. If inflation continues to cool, if economic growth remains resilient, if the Federal Reserve keeps interest rates higher for longer, and if the US dollar stays relatively strong, then gold could struggle to generate the dramatic gain some investors expect. That perspective deserves serious consideration. Higher interest rates increase the opportunity cost of owning gold because gold itself produces no income. When Treasury bonds offer attractive yields, many investors prefer assets that generate regular returns. This is one reason gold prices sometimes move lower even during periods of economic uncertainty. Short-term market movements often reflect changing expectations about interest rates rather than changes in gold's long-term role. There is another important point many investors overlook. Large banks publish forecasts, not guarantees. Forecasts are based on assumptions about inflation, growth, monetary policy, geopolitical events, and investor behavior. If those assumptions change, the forecast changes as well. That is why successful long-term investors rarely focus on a single prediction. Instead, they constantly ask whether the facts are changing. Markets reward flexibility far more often than certainty. 3 possible scenarios for gold. So where could gold go from here? No one knows with certainty. But there are 3 realistic scenarios investors are watching. Scenario 1, the bullish case. Inflation remains difficult to eliminate. Government debt continues expanding. Central banks maintain strong demand for physical gold. Interest rates gradually decline as economic growth slows. In this environment, confidence in paper currencies weakens while demand for hard assets strengthens. Under these conditions, analysts with higher long-term targets believe gold could continue setting new records over the coming years. Scenario 2, the balanced case. Economic growth moderates without collapsing. Inflation gradually moves closer to central bank targets. Interest rates fall slowly rather than dramatically. The dollar remains relatively stable. In this scenario, gold may continue appreciating over time, but at a much slower pace than the most optimistic forecasts suggest. Instead of explosive gains, investors could experience steady long-term performance with periods of both strength and weakness. Scenario 3, the cautious case. Inflation falls faster than expected. Economic growth remains surprisingly strong. The Federal Reserve keeps monetary policy restrictive. Treasury yields remain attractive. The dollar strengthens. If these conditions persist, gold could experience extended periods of consolidation or temporary declines before beginning another major cycle. This possibility cannot be ignored. Every investment carries uncertainty. The future is never guaranteed. What separates experienced investors from emotional investors is not predicting every move correctly. It is preparing for multiple possibilities instead of betting everything on only one. When people look back at important moments in financial history, they often realize the biggest changes were happening quietly long before they became obvious. Markets rarely ring a bell before history is made. Confidence shifts gradually. Policies evolve. Central banks adjust their reserves. Governments make difficult fiscal decisions. Investors reposition their portfolios. And only years later does everyone recognize the significance of those choices. Whether gold ultimately reaches $6,000 or remains far below that level is a question only time can answer. But the bigger question may be this: what are today's financial signals trying to tell us about tomorrow's world? Because the real value of following markets isn't predicting the future with certainty. It's understanding the forces shaping it before they become yesterday's news. That knowledge allows investors to make calmer, more informed decisions instead of reacting to fear or excitement. As always, do your own research, consider multiple perspectives, and remember that no forecast is guaranteed. The goal isn't to chase headlines. The goal is to understand the economic story behind them. If you found this analysis valuable, subscribe and join us for future discussions on gold, silver, inflation, central bank policy, and the macroeconomic trends shaping global markets. Thank you for watching. And until next time, stay informed, stay patient, and always look beyond the headline.